Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy. Got some very interesting news. It came out late last night. We've been doing research all day on this, trying to get the ups and the downs and every which way about it. But YieldMax last night put out a split warning. They are doing a reverse split on 12 funds that have been affected. ULTY and CONY, the two big ones that are going for reverse splits. So we're going to get into that today. And before I do, I got to do a shout out to all of our YouTube subscribers and YouTube members and our Patreon supporters. Patreon already has this information put out there. So if you're not part of the Patreon or if you're not part of YouTube, don't be afraid to hit that subscribe button, hit that bell notification. Don't be afraid to miss a single episode. Let's jump into this and give you guys all the information you need. Notice to all viewers, past performance does not guarantee future results. The information in this video is for educational and entertainment purposes only. If you need financial advice, please contact a financial advisor. I am not a financial advisor. The announcement overview. YieldMax is significant corporate action. YieldMax has officially announced a reverse split of the 12 high-income exchange-traded funds, or called ETFs. This marks a significant event for both current and potential investors in these products. The primary purpose is to consolidate shares and adjust the per price pricing. Two different split ratios are being implemented, a 1-to-10 and a 1-to-5. Now, what does that mean? The split ratios, 7 funds are going to go from 1 for 10. So that means if you own 10 shares of it, they're going to give you 1 share of the new pricing. If you have 5 funds are going to go to a 1-to-5. That means 5 shares for the price of 1. Okay, so it's reversing. They're taking away shares. The implementation dates, they suggested, I've read deeper into it. You may hear different people talk about the different dates, but effective date looks like it's going to be 11/28 of 2025. This corporate action represents YieldMax's strategy to address the challenges with the fund's performance and perception, particularly as 7 funds have experienced substantial NAV erosion leading to single-digit share prices. Now, the affected funds that are going to go from 1-to-10 reverse split ratio, which again, remember, you're going to take 10 of your shares and they're going to roll it to 1. The number 1 fund here will be ULTY, the YieldMax Ultra Option Income Strategy ETF. Number 2 is going to be CRSH, the YieldMax Short Tesla Option Income Strategy ETF. DIPS, DIPS, the YieldMax Short NVDA Option Income Strategy ETF. Fiat, the YieldMax Short Coin Option Income Strategy. AIYY, the YieldMax AI Option Income Strategy. MRNY, the YieldMax MRNA Option Income Strategy. And then the other big one, CONY, the YieldMax Coin Option Income Strategy ETF. All of these are going to that 1-to-10 reverse split. And most of these are under that single-digit pricing of the funds. So what I did here is I posted what is the ULTY, the SEC reporting that they submitted this. And here's what you read. The Board of Trustees has approved a reverse split of the issued and outstanding shares of YieldMax ULTY. This is going into effect on November 28th of 2025. So you can see here that the reverse split is going 1-to-10. So basically before the split, if you had a number of shares owed, say 1,000, the ETF is about $10. That means the value investment would be $10,000. After the split, you'll have 100 shares that are worth $100 NAV. for the same exact price. So nothing's changed other than you're losing 10 times the number of shares that you have. So the affected funds that are going from the 1 to 5 reverse split ratio is TSLY, the YieldMax Tesla option income strategy, YBIT, the Bitcoin option income strategy, XYZY, the XYZ option income strategy, the ABNB, the Airbnb option income strategy, and OARK, the Innovation Option Income Strategy ETF. These are going to a 1 to 5 split, and I'll explain that. Every 5 shares will be consolidated back into one new share. So that's going to increase the per share price by a factor of 5. Now, how a reverse split works. The reverse split definition is a reverse split is a corporate action where a company reduces the number of outstanding shares by consolidating them into fewer, more valuable shares. Critically, the process does not alter the total price market and the investor's holdings immediately after a split. So, like I said, you're going to have the 1 to 10 split. You're going to have 10 of your shares. You're going to get issued one new share. The value of your shares of those 10 was $80 beforehand. After, your one share will be worth $80. So you're really not losing anything in a reverse split. All you're doing is you're condensing 10 shares into one. Same thing with a 5. You're going to take 5 shares, condense it into one. The consolidated shares will increase the per share price. It maintains the unchanged total investment value, and it will also adjust the net asset value per share. Now, share consolidation impact. What changes? There's going to be fewer shares. You'll own fewer shares after the split. The higher value, each share will have a higher per share value and the unchanged total value. Very similar to what I just talked about right there, 10 to 1, 5 to 1. A reverse split essentially is a mathematical adjustment that consolidates your shares and proportionally increases the per share price. It does not create any additional increase in the investor's value. So why is YieldMax implementing these splits? Well, combat NAV erosion. Many YieldMax funds have experienced substantial net assets value erosion, the NAV erosion that we talk about. With share prices falling into single digits, reverse split can increase the per share price to address that NAV erosion. Enhance funds image. By consolidating shares to increase the per share price, YieldMax aims to present a more attractive image for its funds. So you're going to see on the board, it's going to go from 85 cents to $8.50. Wow, big change. But the perception is the big change, but nothing has changed at all. Avoiding delisting. A low price ETF can be faced negative investor perception and in extreme cases potentially delist concerns from the exchange. So they're doing this to try to protect themselves so that they don't get on the delisting side of it. Now, the implement of reverse split represents YieldMax strategy to address changes with funds performance and perception in the current market environment. It does not change the process. It does not change the covered call system. It does not change what is actually causing the failure. So, my view of all of this, the reverse split is a cosmetic split that does not address the fundamental issues. I'll say that again. It's a cosmetic fit that does not address the fundamental issues that has caused the funds to drop. Only changes the appearance of the share prices. It does not address the root cause of the NAV decline. It purely mathematically adjusts the value of the fund and not the value creation. What it doesn't solve is the continued NAV issues, the high distribution rate strategy problems, and the covered call strategy limitations. What they're doing is they're taking this to another hill. They're going to take it to a higher level, and then you'll still have your slow progression of NAV loss. But what will happen is we forget. We forget things. We as people, human beings, forget. 3 months, 6 months down the road, we'll look at this fund again and say, wow, look at this thing. It went from 85 cents to $8.50. It really must be doing good. Just like when ULT back in March made their big announcement, we're changing our strategy, we're changing different things. And it went to weekly versus monthly. And we went from that hill all the way down to where we are today, NAV erosion. We haven't fixed it. So I am very skeptical about this entire strategy effectiveness. I'm questioning if we're not true value creation is occurring, what is actually going to happen? The underlying performance issue, the high distributions, the NAV erosion from high distributions is been hurting the funds. Strategy of paying out high distributions continues to the continuous reduction of NAV. YieldMax is not changing this structure. They are going to continue with this same structure. Dividend payments directly erode the fund's net asset value. The other thing that I personally look at when I do my reviews, I look at assets under management. When you start seeing assets under management reducing, you know they're paying out distributions more than what they're collecting. We had this conversation when a couple of videos back, I had people comment about my answer to the return of capital and the assets under management. And many people said I was wrong, that I did not do this correctly. And what it's showing is that the assets under management has dropped dramatically. The net asset value has dropped continuously. And we're now into a reverse split. The covered call strategy. In bull markets, a covered call strategy limits the upside potential so that the fund cannot recover its value when it drops. The effective structure prevents capturing the full growth of the underlying assets and results in relative decline in NAV compared to underlying assets. So you see in the yellow line, the covered call program is great in strong markets, but when we start having pullbacks and when we have issues like in a bull market, the underlying asset will grow while that's capped on the upside. This is the problem that you run into with covered call strategies from YieldMax. Granite Shares uses a covered call strategy, but they also use a leverage, 2 times leverage for growth. And Roundhill uses a 1.2 times leverage for growth and uses that for natural growth of the funds. So the important implementation dates, everything that I personally have read, all the research that I have read, and I highly suggest you guys do the same thing. I will put this information in the description down below. November 28th of 2025 is going to be the effective date. So on the first day of trading of December 1st of 2025, everything will be in place. The 1-to-10 reverse split, on funds like ULTY will show at that time. The 1-to-5 reverse split on the other funds, you will see that at the same time. I have all the SEC filings down below. You'll be able to read those for your own research. Key investor warnings. Do not mistake post-split prices for genuine growth. I can't warn you enough. The total value of your holdings remains unchanged after the split. That is not natural growth. Understanding this misconception, post-split price increases does not equal growth. Reverse splits are purely mathematical adjustments, and the total value remains consistent immediately after the split. Once it goes into trading, what's going to happen? Well, some people will think of this as a positive and they'll buy some more shares. Other people will say, oh, this is going the wrong way, and the value can go up or down. My opinion, what I've seen from reverse splits, that the fund starts to drop again. So what investors should understand, price increases do not reflect actual growth of the fund. Underlying performance issues remain unchanged, which means the problems are still here, guys. The higher post-split price is artificial and is not indicating of improved fundamentals. I can't express that enough. This is going to nothing's going to change the way we process everything. The way YieldMax does their business will not change. Final takeaways and conclusion. Now, I'm going to put it very clearly to everybody. This is not financial advice. This is just my opinion and the way I interpret the data. The key insights for investors, mechanical adjustments. The reverse splits are primarily mathematical adjustments that consolidate shares and increase the per share price without changing the investment value. The performance signal, the split signals that YieldMax acknowledgement of the significant NAV loss and the challenges with the distribution model. Critical warning. Don't make mistake for higher post-price or post-split price of genuine growth. The total value of your holdings remain unchanged. The performance issue stems from the high distributions and covered call strategies. This split is a cosmetic fix that doesn't address the fundamental challenges of the YieldMax covered call strategies. Focus on understanding true performance challenges rather than being distracted by share price adjustments. Everything that I have read, and I highly suggest you read the same. YieldMax is putting, the old saying, lipstick on a pig. They are just making changes to make the price look better, and then down the road we will forget about it. And I highly suggest we don't. This is not a fix to the problem. This is band-aiding the problem. Tell me what you guys think. I hope this information comes helpful to you. Let us know in the comments below.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.